You pay your insurance premium every single month. Every month. For your home, for your car, for your health, for your life. You pay it because you believe that when the worst happens, when the hurricane hits, when the wildfire burns, when the diagnosis comes, when the accident happens, the insurance company will be there. That is the entire deal. That is the contract. And in 2026, there is a growing body of evidence from actuaries, from state insurance regulators, from reinsurance giants, and from the bond rating agencies that for a significant and growing number of insurance companies, that promise is becoming mathematically impossible to keep. And when insurance companies cannot pay their claims, what happens to your home, your health, your savings, and your entire financial life is something almost nobody is prepared for. In the next 10 minutes, I'm going to show you exactly why this is happening in 2026, what the historical record tells us about insurance company failures, how the consequences cascade into your financial life in ways you have probably never considered, and precisely what you need to do right now to protect yourself. Let me start with the basics, because I think most people understand insurance the way they understood banks before 2008. They trust it without fully understanding how it works, and just like with banks in 2008, not understanding the mechanism means you cannot see the vulnerability until it is too late. Here is how insurance companies actually make money. They collect premiums from policyholders, from you, and they invest those premiums in financial assets, primarily bonds, while maintaining reserves sufficient to pay expected claims. The entire business model depends on two things being true simultaneously. First, that the premiums they charge are sufficient to cover the claims they will eventually have to pay. This is called underwriting profitability. Second, that their investment portfolio generates enough return to supplement underwriting income and build the capital reserves that regulators require them to maintain. When either of those two pillars develops cracks, the business model comes under stress. When both develop cracks at the same time, which is exactly what is happening in 2026, the stress becomes existential. Let me start with the underwriting side, because this is where the most visible and the most alarming deterioration is happening in 2026. The insurance industry's underwriting profitability is being destroyed by climate-related losses at a speed and scale that the actuarial models built even 10 years ago did not anticipate. The numbers are staggering. In 2023, global insured losses from natural catastrophes reached approximately $108 billion, the fourth consecutive year above $100 billion. In 2024, that number climbed further as Atlantic hurricane activity, western U.S. wildfire losses, and flooding events in multiple regions produced losses that would have been considered extreme outlier events a decade ago, but are now occurring with alarming regularity. In 2025, the California wildfires alone, the January 2025 Los Angeles fires that burned through some of the most expensive real estate in the world, produced insured losses estimated at $35 to $45 billion from a single event cluster. And here's the critical insurance industry dynamic that most people do not understand. Insurance companies don't just insure your house against these events directly. They themselves buy insurance, called reinsurance, from reinsurance giants like Munich Re, Swiss Re, and Hanover Re, to protect against catastrophic loss years that would otherwise wipe out their capital. It's insurance for insurance companies. And in 2025 and 2026, the reinsurance industry has been dramatically pulling back, raising prices, reducing coverage, and in some cases exiting entire geographic markets, because even the reinsurers have concluded that the risk is no longer adequately priceable at levels that make business sense. When reinsurers pull back, primary insurers, the companies you buy your homeowner's policy from, are left holding more risk on their own balance sheets. And when they cannot adequately price that risk into premiums that consumers can afford or that regulators will allow them to charge, they face a stark choice. They can continue writing policies at inadequate premiums and absorb losses that eventually erode their capital below regulatory minimums, or they can exit the market entirely, which is exactly what State Farm, Allstate, Farmers, and several other major insurers have done in California in 2023, 2024, and 2025, declining to renew homeowners policies for hundreds of thousands of California residents. Florida has had the same experience, but even more extreme. The Florida homeowners insurance market has been in crisis since 2017. By 2023, 12 Florida-based insurance companies had gone insolvent in a period of 5 years. Citizens Property Insurance, Florida's state-backed insurer of last resort, grew from approximately 400,000 policies to over 1.4 million policies as private insurers fled the market, now holding more risk on a state government balance sheet than any actuarially sound private insurer would accept. And here's why this matters beyond Florida and California. The crisis that started in the highest risk coastal and wildfire zones is spreading. Insurance companies are now reassessing their exposure in states and regions that were previously considered low risk: Tornado Alley, Midwest flooding zones, Gulf Coast states beyond Florida. The actuarial maps are being redrawn in real time, and the areas that are being reclassified as high risk and therefore uninsurable at affordable prices or uninsurable at all are expanding every year. Now, let me take you to the second pillar, the investment side of the insurance business model, because this is the dimension of the insurance crisis that is almost entirely invisible to the average policyholder, and it's potentially more systemically dangerous than the underwriting side. Insurance companies are among the largest institutional investors in the world. The U.S. insurance industry collectively holds approximately $8 trillion in invested assets as of 2026. The vast majority of those assets, typically 60 to 70%, are held in fixed income securities, bonds, U.S. treasuries, corporate bonds, municipal bonds, mortgage-backed securities. Insurance companies hold bonds because their liabilities, that claims they will eventually have to pay, are relatively predictable and long-dated, and bonds provide stable, predictable income streams that match those liabilities. Here's the problem that began in 2022 and has not been fully resolved as of 2026. When the Federal Reserve raised interest rates aggressively, 11 times in a 2-year cycle, the market value of existing bonds fell sharply. A bond paying 2% interest when rates rise to 5% is worth significantly less than it was when it was issued. Insurance companies that had loaded up on long-duration bonds during the near-zero interest rate era of 2015 to 2021 suddenly found themselves sitting on massive unrealized losses in their investment portfolios. This is exactly the same dynamic that destroyed Silicon Valley Bank in March 2023, except SVB was a relatively small regional bank. We're talking about this dynamic playing out across $8 trillion of insurance company assets.
Now, to be clear, insurance companies are not required to mark their investment portfolios to market the way banks are. They can hold bonds to maturity and never recognize the unrealized losses on their balance sheets, as long as they do not have to sell. But here is the critical constraint. If a major catastrophe event forces an insurance company to liquidate portfolio assets to pay claims, and those assets are sitting on significant unrealized losses, the act of selling converts unrealized losses to realized losses, eroding the capital base below regulatory minimums. This is the intersection of the underwriting crisis and the investment crisis. A bad catastrophe year combined with a bond portfolio sitting on unrealized losses is a genuinely dangerous combination. And there is a third dimension that ties both of these together. Life insurance companies and annuity providers, the companies holding your life insurance policy, your annuity contract, potentially your pension, have their own version of this stress. Long-term care insurance is particularly alarming. Companies that sold long-term care policies in the 1990s and early 2000s priced those policies based on assumptions about longevity, healthcare cost inflation, and interest rates that have all proven dramatically wrong. Americans are living longer than expected. Healthcare costs have risen faster than expected. And the investment returns these companies expected to earn on their reserves, assumptions based on the interest rate environment of the 1990s, were obliterated by 2 decades of near-zero rates. The long-term care insurance sector is in a slow-motion solvency crisis that is not widely covered, but that affects millions of Americans who purchased these policies expecting their long-term care needs to be funded. So, we have an insurance industry that is simultaneously facing underwriting losses from climate events that are exceeding actuarial models, investment portfolio stress from a decade of rate volatility, and long-term care reserve inadequacy that has been building for 2 decades. All 3 of these pressures are present simultaneously in 2026. None of them is new, But the combination of all three in a single period is creating levels of industry stress that regulators are privately more worried about than their public statements suggest. Let me take you back through history, because the failure of insurance companies is not a theoretical scenario. It has happened before, multiple times, and the consequences when it happens are severe, long-lasting, and personal in ways that reach far beyond the policyholders of the failed company. The most instructive recent example is the AIG near collapse of 2008. AIG, American International Group, was at the time the largest insurance company in the world. It insured everything: planes, ships, corporate assets, and crucially, it had a financial products division that had sold hundreds of billions of dollars of credit default swaps on mortgage-backed securities. When the housing market collapsed in 2008, AIG's financial products division faced claims it could not pay. The potential failure of AIG would have been catastrophic, not just for its policyholders, but for every major bank and financial institution globally that had purchased AIG's financial guarantees. The U.S. government stepped in with an $85 billion bailout that ultimately grew to approximately $182 billion. The systemic risk of an AIG failure was considered so severe that the government had no choice but to intervene. But AIG was saved by government intervention. Not all insurance companies are large enough or systemically important enough to receive that kind of rescue. The 1980s and early 1990s saw the failure of dozens of property and casualty insurance companies following natural disasters and investment losses. The savings and loan crisis destroyed numerous insurance subsidiaries. The executive life failure in 1991 affected approximately 350,000 policyholders who held annuities and life insurance policies and had to wait years for partial recovery of their claims. And then there's Hurricane Katrina in 2005. The most instructive catastrophe event for understanding what happens when insurance claims overwhelm insurance company capacity. Katrina produced approximately $45 billion in insured losses at the time, a record that stood until it was surpassed in subsequent years. Several smaller insurance companies became insolvent. The state-backed Louisiana Citizens Property Insurance Corporation, Louisiana's insurer of last resort, faced financial distress requiring state government intervention. Tens of thousands of policyholders faced lengthy delays, disputed claims, and in some cases, recoveries that were cents on the dollar compared to their actual losses. So the lesson from Katrina that is most relevant for 2026 is the role of the state guarantee funds. Every U.S. state has an insurance guarantee association, a system designed to pay claims when an insurance company becomes insolvent. These are not federal programs like FDIC deposit insurance. They are state-level mechanisms funded by assessments on surviving insurance companies in the state, and they have significant limitations. Coverage limits vary by state, but are typically $300,000 to $500,000 per claim, which in high-value real estate markets like California and Florida may cover only a fraction of a major loss. And critically, if multiple insurance companies become insolvent simultaneously, the guarantee fund mechanism can be overwhelmed. In 2026, the scenario that regulators are quietly modeling is exactly this: a major catastrophe event or series of events that produces losses large enough to simultaneously stress multiple insurance companies in a single state, overwhelming the guarantee fund and leaving policyholders holding partially paid claims. The Florida market, where 12 insurers failed in 5 years and where Citizens Insurance holds 1.4 million policies on a state government balance sheet, is the most acute example. But it is not the only one. All right, let's talk about what you actually do, because knowing this risk exists without doing anything about it is not a strategy. It's just expensive awareness. Standard disclaimer first. Nothing here is personalized financial or legal advice. Your specific situation requires qualified professionals. What I'm giving you is a framework based on how financially sophisticated people think about insurance counterparty risk. Use it as a starting point. The first thing you need to do right now is check the financial strength rating of every insurance company you do business with. This is not difficult. AM Best, Moody's, Standard & Poor's, and Fitch all publish financial strength ratings for insurance companies. These ratings assess the insurer's ability to meet its ongoing insurance obligations, its claims-paying ability. You want to see AM Best ratings of A- or better. A B+ or below rating is a warning signal that deserves serious attention. for your homeowner's insurer, your health insurer, your life insurer, your auto insurer. Look up the rating today. If you can't find it easily, call your insurance agent and ask directly. Any reluctance to provide that information is itself a warning signal. Second, understand your state guarantee fund coverage limits. Every state has an Insurance Guarantee Association website. Find yours, look up the coverage limits for homeowners insurance, life insurance, and annuities in your state. In many states, homeowners coverage through the guarantee fund is capped at $300,000 to $500,000. If your home is worth $800,000 and your insurer becomes insolvent, you may recover a fraction of your claim through the guarantee fund. Understanding this gap is the first step to addressing it, either by choosing a higher-rated insurer, by adding a surplus lines policy as a supplement, or by building your own financial reserve against this scenario. Third, diversify your insurance counterparties where possible. Most people have all of their insurance, home, auto, umbrella, sometimes life, with a single insurer or a single insurer group for the convenience of bundled discounts. There's a real cost to that convenience if that insurer faces financial stress. Consider whether the bundling discount is worth the concentration risk, particularly for your largest exposures, which are typically homeowners and life insurance. Having your homeowner's insurance with a different company than your life insurance reduces the scenario where a single insurer's failure affects all of your coverage simultaneously. Fourth, pay specific attention to your homeowner's insurance situation if you live in a high-risk zone. If you live in California, Florida, Texas Gulf Coast, Atlantic coastal states, or anywhere in the wildfire-urban interface that has expanded dramatically in recent years, your insurance situation deserves immediate and careful attention. If your current insurer has a below A financial strength rating, if your premiums have increased 40% or more in recent years, or if your insurer has indicated it may not renew your policy, these are all signals that require action. Look at the state FAIR plan options, the insurer of last resort in your state, understand what it covers and what it excludes, and consider whether additional surplus lines coverage is available and appropriate for your situation. Fifth, for life insurance and annuities, the financial strength rating matters even more because these are long-duration contracts. You're betting that the company will be solvent not just today, but for the next 20 or 30 years. A life insurance company that is financially stressed today may be insolvent in 10 years. The companies with the strongest long-term track records and the highest financial strength ratings, Northwestern Mutual, New York Life, Guardian Life, Mass Mutual, are mutual insurance companies, meaning they are owned by their policyholders rather than by shareholders. Mutual insurers have historically maintained stronger capital positions than stock insurers because they don't face the same quarterly earnings pressure to optimize returns at the expense of reserve adequacy. Sixth, build your own financial buffer. I know this sounds like the most generic financial advice imaginable, but in the context of insurance counterparty risk, it has a specific meaning. Your emergency fund, 3 to 6 months of living expenses, is not just a buffer against job loss or unexpected expenses. It's your first line of defense in the period between when a major loss event occurs and when your insurance claim is actually paid. Even a solvent, well-capitalized insurer takes weeks to months to fully settle major claims. An insurer under financial stress may take much longer. Having a cash buffer means you can manage your life while the insurance process runs its course without being forced into desperate financial decisions.
Let me give you the bigger picture that ties all of this together, because the insurance industry crisis of 2026 is not just about individual companies failing to pay individual claims. It is about a systemic stress in a sector that is far more deeply embedded in the financial system than most people realize. Consider the mortgage market. Banks require homeowners insurance as a condition of a mortgage. If insurance becomes unavailable or unaffordable in a region, which is already happening in parts of California and Florida, homes in that region become effectively unmortgageable. Without a mortgage market, home values collapse. Collapsing home values hit bank balance sheets through mortgage defaults and reduced collateral values. A regional insurance availability crisis can trigger a regional housing and banking crisis through exactly this mechanism. We are already seeing the early stages of this in the most insurance-stressed markets.
Consider municipal bonds. Many local governments and public institutions depend on insurance for their infrastructure, schools, utilities, public buildings. If their insurer becomes insolvent or dramatically raises premiums, their operating costs spike and their creditworthiness deteriorates. Municipal bondholders, which includes millions of individual investors holding muni bonds for their tax advantages, face credit risk from insurance stress that they have never historically needed to price into their analysis. And consider the reinsurance dimension one more time. The global reinsurance market is dominated by a handful of very large companies: Munich Re, Swiss Re, Hanover Re, Lloyd's of London syndicates. If climate losses continue escalating at their current trajectory, even these giants face capital adequacy questions. In 2025, Munich Re reported that climate-related losses were running above its long-term model assumptions. Swiss Re has explicitly stated that certain risks may become effectively uninsurable if the physical risk environment continues deteriorating. When the reinsurance giants start talking about uninsurability, the primary insurance market and the policyholders who depend on it are facing a genuinely different world. The honest assessment is that the insurance industry in 2026 is navigating a stress that is structural, not cyclical. Climate risk is not a bad year that will be followed by a good year. It is a ratcheting upward of the baseline loss expectation. Interest rate volatility has reshaped the investment side of the business in ways that are still being fully felt, and long-term care reserve inadequacy represents a slow-motion liability that has been building for 2 decades and has not been fully addressed. None of this means the insurance industry is about to collapse. The largest, best-capitalized insurers, the A+ rated companies with conservative underwriting, strong reinsurance programs, and well-managed investment portfolios, will navigate this environment successfully. But the weakest players in the market, and there are more of them than you might think, are genuinely at risk, and the policyholders of those weak players are at risk alongside them. Here's what I want you to walk away with. Insurance is not a passive background expense that you pay and forget about. It is a financial contract with a specific counterparty, a specific company. And in 2026, the financial health of that counterparty matters more than it has in decades. Climate-related losses are exceeding actuarial models. Investment portfolios are carrying stress from years of rate volatility. Long-term care reserves are inadequate, and the reinsurance backstop that the industry has traditionally relied on is becoming more expensive and less available. The response is not to panic and cancel your policies. The response is to be an informed insurance consumer. Check the financial strength ratings of every company you insure with today. Understand your state guarantee fund limits. Diversify your insurance counterparties where it makes sense. Build your own cash buffer as a bridge against claim delays. And if you live in a high-risk zone, take your insurance availability and affordability situations seriously, because the early warning signs are already visible. You have now thought more carefully about insurance counterparty risk than most people with significant assets will do in their entire financial lives. That is genuinely valuable. Use it. Drop a comment below. Have you ever checked the financial strength rating of your insurance company? Do you know what your state guarantee fund covers? These are questions most people cannot answer, and I genuinely want to know where you stand. If this video made you think differently about your insurance, if it revealed a risk you had not considered, hit that like button. One click genuinely helps this reach more people who need to hear it. Subscribe if you want financial intelligence that goes beyond the headline numbers and into the structural risks that most coverage misses. Turn on notifications. Share this with one person in your life who owns a home, has a life insurance policy, or has an annuity, because that person needs to check their insurer's rating today. Coming up very soon, we are going deep on what happens to the U.S. housing market when mortgage rates stay elevated and insurance availability collapses simultaneously. That intersection is one of the most important and underreported financial stories in 2026. You do not want to miss it. I will see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.